Welcome back to the Mentored Show, which offers quick lessons packaged within minisodes for busy founders and startup leaders like you. I'm Adel, and I'm being mentored live and unscripted by Ed, who's built, sold, turned around, and scaled startups all the way to the New York Stock Exchange. He's based in the US, a developed economy, and I'm based in Dubai, a hub within an emerging economy, and we compare notes. This is real talk, no scripts, no theory. Let's get into it. Most early investors, their motivation is fueled by their emotions more than logic or more than wanting to make money.
I think investors that have a lot of money, let me just say this differently. Investors that have money to put to work outside their normal stock investment or real estate investment or whatever they normally would do with their cash, they're absolutely going to make an emotional decision. So do VCs, so do private equity investors. I think the difference is that many high net worth families that have money to invest will invest on the positive outcome model. They expect everything to go fairly well. And when they become disappointed, their wallet shuts. They become very reluctant to write another check. A more professional investor will know that they're investing for the longer term. They're willing to accept disappointments and bumps in the product roadmap and the execution. So when you're measuring an emotional decision-making individual or institution, understand, are they only a fair weather investor, or are they an investor that has the ability to deal with disappointment but still stay the course? Now, they won't stay the course indefinitely. And I'll give you many examples, but one that comes to mind is a young company. It's 5 years old today. So far, it has raised $40 million in venture capital from both individuals as well as institutions. Same CEO. 5 years later, $40 million later, the company does barely $8 million in revenue. Very poor execution. At this point, the investors are fragmented. Some want out, some want to continue to stay in because they were the most recent investors and they want to see a return on their money. And interestingly enough, no one wants to fire the CEO. And yet that's exactly what the business needs, is a change of leadership. Idea is good. It's a tech company. The market is definitely there. Their competitors are doing well. So execution is very poor, right? What is going to happen is that the next round of financing that's coming in, $10 million, is going to come in at very punitive terms. So the pre-money valuation is very low. It's a down round. The terms of the money coming in, it will have a preference, a 2 times preference on the money. So if the company sells, the first 20 million goes to the most recent investor. Okay? Very, very punitive. If the company sells for anything less than $50 million, none of the founders, none of the executives, none of the employees will make any money, right? The early investors will be lucky to get their cash back, not a return, just the cash they put in. And the vast majority of profit from the sale will go to the most recent investors, okay? Why? Because of flight to quality, because this company did not grow, this company is not profitable, it did not execute. So the last money coming in is going to put very difficult terms. And if you decide not to play on your pro rata basis as the earlier investor, you're going to get crushed.
I'm just imagining how difficult the situation would be for, especially like the CEO, to admit that, you know what, I'm not doing well, we're not doing well. We either have to sell the company, shut the company down, or accept this new money that comes in at a lower valuation. The resistance that he or she would be facing from the board, from the investors. Do you have any stories that you can share with us or examples? I'm just assuming that because the market here and the emerging markets is not mature enough, there will be lots of companies continuing to take money, continuing to make promises, but I'm not sure until when. There has to be like one company that will go bankrupt and burn the whole industry in the country or in the region. And because their story will become suddenly famous, and it will turn into a benchmark on what to do, what not to do, which is good. It will educate the investors, but at the same time, I feel it will hurt all the other startups because suddenly money will become difficult to raise, even for good projects. Yeah.
It's a very good point you raise. I would say that there's a lot of lessons that entrepreneurs can take from the very recent past, the current times, the very recent past, and certainly over the history of investments into startup companies over the decades. I'd say one lesson is, again, be brutally honest with yourself as an entrepreneur. It's great that you have an idea. It's great that you can tell a story, create some enthusiasm around that story and raise money. But you have to be singularly focused on successful growth and ultimately profitability. And anywhere along that journey, whether that journey is a year, 5 years, 10 years, you should always be asking yourself, am I the best fit for my role as founder CEO for where the business is? Because not everyone will grow and scale to where your company is going. And one of three things would possibly happen. You're really good from idea generation to the first $5 million of revenue. You could be very good at that. But going from 5 to 10 or 5 to 20 is a whole different mindset and skill set. You're no longer the startup CEO founder. You're no longer the get your hands dirty. You now start to need to think about scaling at the very lowest levels, but you're still scaling. You should be open to the idea that at some point you might not be the best candidate for CEO to take the company to the next level. And if you say, it's my company, no, it's not. The minute you raise outside capital, that business is an entity unto itself. It is no longer about you. It's about your investors. It's about your customers. It's about your employees. And if you're not well equipped to grow the business from 5 million to 50 million, 5 million to 10 million, whatever the number is, at least have the maturity and the respect for your investors to say, I'm not the best person. I think we need to go bring in an outside talent, right? That's thing one. That's one option. The second option is your ego gets in the way and your business flatlines, like the story I said earlier, for 5 years of no growth, 10 years of no growth. Any company that flatlines needs to start asking itself, am I in a market that matters? Do I have a total addressable market that makes sense? Or am I just a shitty CEO? Because that's actually a legitimate answer. That's the second option, right? Is your ego gets in the way and you waste time and money. The third outcome is your investors get fed up with long excuses that comes in a board meeting. We didn't hit our number because we didn't get profitable this quarter because it was someone else's fault. That's why I'm replacing the CTO or the CFO, or you're replacing everybody except yourself. And at some point, your investors will just fire you to preserve the potential for a positive outcome. And why do I know this? I know this because when I hear a board of directors or a CEO say to me, yeah, we've replaced the management team 3 times. That sends a red flag. Why would you have 100% turnover in your executive team except you, the founder? That is not a good sign. So 3 different outcomes, right? 1, you have the temerity to replace yourself when you've reached your potential. 2, you flatline the growth of the company and the opportunity because your ego gets in the way. And 3, you'll get replaced because you're not performing. So the common thread in all of these statements is you've got to focus on performance, on execution, grow the top line, move towards profitability.
That's it for this minisode. Big thanks to Ed and to all of you for tuning in. If this sparked something, hit subscribe so you don't miss the next one, and make sure you share it within your network. Got a question for Ed? Drop it within the comments. See you next time.
Please note, the views and opinions expressed in this podcast are those of the host and guests and do not necessarily reflect the official policy or position of any affiliated organization. The content provided is for informational purposes only and should not be considered as professional advice. We encourage listeners to conduct their own research and consult with relevant professionals before making any business or career decisions.